Hi there, Etoro. It is Monday, the 27th of June, and that means it's time to take a look at what moved the markets last week. Now, there weren't as many big news items as there usually are, so this video should be quite short, but going through it in the usual way. If we take a look at the NSDQ one-day chart for the past week, we can see that there's been an enormous bounce from the lows. The question now on everyone's lips is this just a relief rally, a bear market rally, or is this the true bottom of this bear market? And from now on, we will see maybe not a straight line, but a line to the right and upwards. Well, no one knows, but that remains to be seen. We can see that on Friday there was a particularly strong day, and that is true also of the S&P 500, and we can see that there's been some really strong volume in the past week or so. Looking at the Chinese market for a second, the CSI 300, we can see that this just continues to power higher, and it's getting pretty close to that moving average, the 200-day moving average, which by many people's definition would mean that it has broken out of its downtrend. The momentum, the price action, and the volume is certainly on the side of the index at this point in time. It's supported by policy within China and also the easing of coronavirus restrictions, which should see the people and companies within that economy lapping up the liquidity that's available there. What this means for particular stocks on the ground, well, the very popular Alibaba, which has been in an enormous downtrend for a long time, since October of 2020, has seen a rebound of about 47% through. This includes today's session, but obviously a very large rebound from the recent lows, not from the ultimate lows. So lots of big green bars in terms of volume. This tells you that buyers are coming back in droves. I also quickly wanted to look at Prosus, which is an interesting company, a complicated company, and which is largely been seen as a proxy for Chinese equities. One very large company in particular, you can see that there's been an enormous jump today, and this is because it's selling shares in one of its best investments ever, Tencent, in order to fund share repurchases. This company has got a very interesting history as a very complicated share structure, even more complicated than the Chinese shares on their own. So I won't be able to do a deep dive today. I wanted to call this one out just because of the enormous jump in the stock price today, but you can see that for the past few weeks it's been in a pretty decent uptrend anyway. Looking at the economic calendar for the past week, the pieces of data coming out of the countries that I choose to subscribe to, there was a smattering of data coming out. The US was on holiday on Monday. The CPI data, inflation data, came out of the UK, and it was very high, but not higher than expected really. Still not a great place to be. The PMIs coming out of the UK saw the composite was up, services were up, beyond expectations, that is, manufacturing lower than expectations. And this reinforces the narrative that people are buying less stuff and instead spending more money on services. Anyone that's been out in London during a weekend, I think, can attest for the number of people I can see in the streets, and so the service industries are doing very, very well at the moment. However, I would say that the market was probably most interested in Fed Chair Powell testifying on Wednesday and Thursday, so giving a bit more information about the Fed's position and their plans. And he came out quite hawkish, more hawkish than I expected him to be. So he said his commitment to curbing inflation is unconditional. He's hammering home this message that no matter what it takes, he would like to bring inflation down, even if that means pushing the US economy over into a recession. Unfortunately, I couldn't find one article with all of the key comments that he made, but he said that 75 basis points increase again in the next month is likely. He also said that 100 basis point increase, not necessarily next month, isn't off the cards. But the long and short of these meetings was that he is ultimately committed to bringing inflation down. So inflation is the thing that the market cares about the most at the moment. It's also a political hot potato, and Biden will be very interested in bringing that down as fast as possible. So the government and the Fed are, in theory, separate entities, but I'm sure that there's a fair amount of political pressure there. So we can see along the bottom here, I guess it's a little difficult to see because of the color, maybe, especially if you're on a phone, but the Fed funds rate at the moment is roughly 1.6. So they wanted between 1.5 to 1.75%. They've laid out their plans for the next year and a half or so, but this is just the current rate. They've already let us know what to expect from the short term, medium term, and we can see the rate that the market expects that the Fed will get to in the 10-year Treasury yield. Now, you might be asking yourself, if the Fed is so hawkish and we know that interest rates are only going to go up, why were the markets rallying last week? Well, first of all, a lot of what the Fed has been talking about was already expected by the market and has been priced in. I think that some sort of slowdown in GDP growth and potentially a shallow recession are priced into equities, more so in some areas than others. But also what we're continuing to see, and let me zoom in here a little bit, is that commodities are continuing to get cheaper. Now there's a little rally on the day, but the 1 week chart, you can see that things such as nickel, wheat, natural gas, copper, iron ore, oil, they're all down on the week and down on the month. Continuing what I said from last week, so if we look at the year-to-date chart for XLE, so this is the sector-based ETF for energy companies in particular, we can see that the price of this has been sliced in half through the past 2 weeks. And so this kind of news is becoming quite important to the market. We're seeing it a lot in the headlines, and it's quite typical in a bear market for the energy sector to be one of the last areas to tank. So as I said before, the market is the most worried about inflation. So the secondary worry about a recession and a slowdown, and it's been taken as good news because it's considered less bad than inflation that continues to push higher. Now at first, this might not seem to make sense, but it kind of does. You can see what the market participants are thinking here. If the prices of commodities roll over, so if these basic building blocks for our economies begin to fall in price, then the things that are made from them also begin to fall in price. If there is a recession, usually everyone is tightening belts, companies become smaller, the employment rates begin to drop. And so the hope out of this bad news is that inflation is defeated by the central banks, and the stock market is always trying to price in whatever comes next. So if inflation is defeated, interest rates might continue to rise, but do they rise a bit more slowly? Does quantitative tightening slow down? And these are the things which accommodate growth within an economy. So the market is trying to be a little bit ahead of our current bad situation. I think that when the realities of a recession set in, we'll probably see another delayed reaction from the market, and I expect some selling on the back of that too. But for now, the less bad news of a potential slowdown versus inflation has been taken as, kind of good news. We've seen bits and pieces of news out of China over the weekend, and Shanghai has declared victory over its recent COVID-19 outbreak. I think that this might be a thing that keeps on happening over and over because they've got this particular policy, this COVID-0 policy. But on the ground in China, there's a very accommodative policy when it comes to economic growth. And while there are lockdowns happening here and there, outbreaks of coronavirus, the country is definitely reopening more than it is locking down. And this means that the economic participants can start absorbing some of that liquidity and putting it to use in terms of growing that economy. The other good news potentially with China reopening is that it is a key component in global supply chains. And so if it reopens completely once again, then we're going to see some of those supply chain issues start to resolve themselves. Something I've been keeping my eye on for a while are the forward PEs for the indices overall, and there's some recent research by Yardeni, fantastic company, about the forward rates breakdown of this data for the S&P 500 in various different ways. I'm not going to go through this whole document, it's 21 pages of charts, but I think what you can see on screen right now tells a particularly compelling story, but with a very strong caveat. So this is showing the forward PE ratio for the S&P 500, and we've got the 500 largest companies, the next 400 companies below that, and the next 600 small cap companies below that. This chart is running from 99 through to now, and so we can see the PE ratio for the S&P 500 has dropped significantly from the highs, and it is sitting around the mean. You can't see that from the chart, I know that number. So the current level is roughly at the mean for the past 20 odd years, or maybe even longer. That's not a bad place to be, but it does mean that the PE could become even cheaper. It's not particularly cheap right now, it's maybe fair value. For the other sets of companies though, the 400 mid cap and the 600 small cap, we can see that the PE ratio is, in terms of the mid cap, pretty damn cheap, and for the small caps, just about as cheap as it has ever been over the past 22-year period. This does make sense because investors tend to sell out of smaller companies when there's some kind of major fear in the market, because small companies tend to be less resilient than large companies. Big companies have deep pockets, and so investors tend to rush to these when they need a bit more reassurance. But this has meant that the S&P 600 small caps are now dirt cheap. And I think a lot of us knew that without even looking at this particular chart. The caveat here, though, is that the PE ratio relies on two pieces of input, the price and the earnings. as the denominator in calculating the PE ratio, obviously. Prices have come down, but analysts are still fairly optimistic in terms of their forecasts for earnings through this year. They're still forecasting growth. The question then becomes, the caveat here is, are the analysts wrong? Are we going to find out through the next earnings season that earnings growth is going to be a lot lower than analysts were expecting? And so you're seeing whispers of this sentiment through articles on the internet at the moment. And usually the key reason for optimism here, optimism mean that earnings continue to be resilient as their consumers in the US are still out, they're still spending, profit margins are still holding up. But of course this conclusion has been drawn based on things that have happened and not necessarily based on things that are happening now and will continue to happen through the rest of this year. And so the long and short of it is, if earnings growth is a lot less resilient than analysts have been saying, then we could see that the PE ratio is not actually as cheap as it currently looks, because this is a forward PE ratio. It's using the prediction of earnings to arrive at a number. But my research leads me to believe that even if earnings were weaker than analysts currently expect, PE ratios for a lot of small cap and mid-cap companies are still much, much lower than they should be. The good news, or maybe the bad news, is that we're going to find out about the next round of earnings towards the middle of July. In my personal opinion, the companies that I own, or that I'm looking to own more of, are super cheap given a horizon of many years. And so I try not to be too concerned if prices are going to fall a little bit further, but rather if these companies are cheap right now and are going to net me a fantastic return over the coming years. All right, looking at what is coming through this week, I've got a lot more data points on here than usual, and that's because I wanted to pull out one thing in particular. The market will be very interested in the GDP quarter-on-quarter number that comes out of the US. So this is expected to be negative at minus 1.5%. If the expectation ends up being correct, I don't think we'll see any major movement in the market. I'll also be quite interested in the GDP numbers out of the UK, but the most interesting piece of data for me will be these PCE numbers out of the US, and we will get those towards the UK afternoon on Thursday. I'm not sure how many of you remember this, but I've been banging on about the various ways that you can slice and dice the inflation pie, and the PCE price index change is the preferred gauge of inflation by the Fed. So it looks as though in recent numbers that it has been rolling over, and it would be nice if we could see this trend continue. We can see that it's supposed to come in at 4.8%, which would be slightly lower than what we saw in April. Just so you know, this does exclude certain things, such as the price of food and energy. That's why the headline inflation number, which includes those, is much higher than this. All right, that's it for this week. In my opinion, I think that China is very well positioned. It is skating on thin ice. There's some pretty big risks when it comes to China, the coronavirus policy, as well as the potential invasion of Taiwan. But right now there's momentum building. The market is incredibly cheap. It's politically a very important year for the government, so they will want to demonstrate that they know what they're doing. And they've turned on the taps when it comes to being expansionary in terms of economic output. All right, that's it for this week, and I'll speak to you soon. Goodbye.